Hi everyone, welcome back to Learn on the Go. I often wonder if I have named this series well. Learn on the Go is good. It connects with the learning that I'm doing on a daily basis. By the way, this is episode number 20. But then I was also watching this one on NDTV Profit. NDTV Profit, Know Your Company. Yeah, this one. What the team here does is that it reviews a company every week and tries to explain what's good, what's bad, and what can be improved within that company. And one of the companies they picked up recently, this one, it's Kamat Hotels. It's a company that I've reviewed before, not in a video, but khud ke liye, I am a consumer of this company, having stayed at their property in Ayodhya for a couple of days, which I must say was an absolutely pleasurable experience. The hotel itself is barely 4 kilometers from the Sri Ram Janmabhoomi Mandir, so excellent location. The rooms aren't cheap, 8, 9, I think I paid 10,000 rupees a night. Right now it's 20,000 rupees. When we were there in March last year, the place was fully booked. The food was absolutely excellent. And जब इतना अच्छा experience मिला है, one of the first things I did when I flew back to Delhi was to review this company and to see if this is investable or not. This video is a compilation of my learnings and I do hope you like it. Okay, let's start this inquisition with a quick history lesson. The Kamath legacy started way back in 1958 when Mr. Venkatesh Krishna Kamath opened the iconic Satkar restaurant opposite Churchgate Station in Mumbai. The success of Satkar, along with other S-branded names like Status and Samrat, made the Kamath name very synonymous with South Indian fast food and hygiene. The second generation, his son Dr. Vitthal Venkatesh Kamath, then pioneered the hotel business after taking over in the 1970s. He incorporated Kamat Hotels India Limited, KHIL, in 1986. It went public in 1994 via an IPO and built hotels in Silvassa, Mumbai, Goa, Jadavgarh, and Pune. The company defines this phase as KHIL 1.0, which was more of an initiation and investment phase. KHIL 2.0 started around the year 2010. Not a good time to be in the hotel business, in part due to a massive slowdown in the Indian economy. Unfortunately for the company, it was over leveraged then with debts of over 600 crores, which was a bit too much for a company whose operating profits were just around 35-40 crores. In fact, one check I always do is to look at the interest coverage ratio, which is the EBIT, the earnings before interest and taxes in the numerator, divided by the interest expense of the company. Okay, let's look at the P&L account. And way back in FY15, March of 2015, we can see the EBIT, which is 33. 33 is the EBITDA. So we subtract the depreciation from there. So minus 31. So this comes to 2 crores. That's your EBIT. And the interest expense is 81. So it's essentially 2 crores divided by 81. Let's try it out in the calculator. Yeah. So 2 divided by 81 gives us 0.02 is the interest coverage ratio in case you are mathematically oriented. But I think it's good enough for us to understand that the company did not have enough money with itself to even pay the interest expense, let alone anything else. Understandably, the company had to improve on a war footing, and to this effect, Kamath Hotels disposed of land and non-strategic assets. It restructured its debt with banks and ARCs, asset reconstruction companies, undertook cost savings, etc. Thankfully, all of this worked, with Kamath Hotels turning profitable once again in 2019, and it even crossed an operating profit of 100 crores in the financial year 2023. By now, the third generation, Mr. Vishal Vitthal Kamath, had also joined the business. He actually joined in 2004, so he's seen the good and the bad days, and is now the chief architect behind the latest version, KHIL 3.0, that the company is presently pursuing. We'll spend some more time on this as a hop between what the company has done in the previous 2-3 years and what it plans to do in the immediate future. Now, the year 2023 was a pivotal year in Kamat Hotels' recent history. And that's exactly where our inquisition starts. By then, we had moved on from the pandemic phase, and KHIL's revenue and operating profits were at least 30% higher than pre COVID levels. The country was spending a lot more on holiday and leisure travel. The government's tourism initiatives, especially around religious places, was picking up steam, and overall there was positive business sentiment and decently high economic growth rate. The first step for Kamath Hotels was to strengthen its balance sheet. For this, the company in January of 2023 successfully raised new capital through a combination of preferential shares and NCDs to reduce debt, which was done via a one-time settlement with lenders. Then in October, the WITS Mumbai property was sold for 125 crores, and the proceeds were used to retire some high-cost debt on the company's books. The effect of these initiatives can be seen here. So see this, in 2023, FY 2023, the interest payable was 16 crores, 16 crores, 13 and 14. This was at an interest rate of 14%. And now that the interest rate had come down to 10.75 and some of the debt had also been retired, the interest expense of the company has gone down to 11, 7, 5, 5, 6, 5, so about 5.5 crores per quarter. Let's see the debt also. As I said, it has come down. So what was total of 320 odd crores of debt, this is long-term plus short-term borrowings, is now down to just 115 crores as of September 30th of 2025. In fact, I want all of you to see this. So in the Q1 FY26 earnings call, Mr. Kamath, that is Vishal Kamath, said, and I quote, "We are already a zero debt company." But when I look at the screener, so this was said in Q2, right? So we have a long-term borrowing of 115 crores. And how much is the cash? Yeah, see, the cash equivalent is 40. There's nothing in the investment column, so no liquid funds probably. So it's 115 minus 40. This comes to 75 crores. So it must make you wonder that why is Mr. Kamath referring to Kamat Hotels as a net debt-free company? Well, it actually depends on how the company defines the phrase net debt. So the way I've learned it, debt, that is long-term and short-term debt minus cash and cash equivalent, gives us the net debt of the company. However, KHIL's definition is a bit different in the sense that if the company's cash in hand plus its EBITDA is more than the total debt, then the company's net debt is less than zero. I know what you're thinking. आपको लग रहा होगा कि शायद गलती से बोल दिया. But here's the thing. In the very same earnings call, Mr. Kamath said that once again. So look at this. Our target is to be net zero this year, which we are easily going to achieve. So 110 crores is the debt, 20 to 25 crores of cash reserve, 90 crores of EBITDA. So essentially 110 minus 20 minus 90 gives us zero net debt. Now this is a problem. So if two people are going to define a certain thing in two different ways, then as an investor and for me as a researcher, things aren't going to be easy and it's only going to complicate matters. The learning here is to get into the details of things, and most definitely, and I've like a broken record, I've been saying it again and again, that a screener is a very templatized version of the financial statements of the company. But when you're investing, when you're researching a company, there's a lot more to it. And I'm particularly picking out on Kamath Hotels here because you'll see a lot more of this in the video, which no screener would be able to capture, but a more kind of dedicated understanding of things. And by reading more stuff, you do get to know a lot of stuff. So let's continue. Okay, we were on the year 2023, and in June of that year, Kamath Hotels launched a new mid-market brand named IRA, which is the hotel type I stayed in during my visit in Ayodhya last year. In barely 2.5 years, the company has operationalized 9 properties under the IRA brand as of Q2 of this financial year. This is over 600 keys, with presence in cities like Dwarka, Sambhajinagar, Mumbai, Goa, Nashik, Noida, Hyderabad, Bhubaneswar, and of course, Ayodhya. So, what was a very Maharashtra based company until 2022 is now in 8 states with 24 properties, with 5 of them opening in the second half of 2025. As it stands, there are 10 Orchids, 9 IRAs, and the remaining 5 properties are shared between the other 3 brands. Also notice this legend here where it says leased, managed, freehold, and revenue share. As it stands, most of the properties are leased. This is the light yellow color. Some are managed, the purple color. Just 2 of them are freehold, and 4 more hotels are under revenue share. This is important and interesting, so let's do it quickly. A freehold is where the company builds or buys the property outright and manages all operations. Basically, it owns this physical asset, which in this case is Orchid Mumbai and Orchid Goa. I'm jumping into KHIL 3.0 a bit, but specific to this freehold model, the management is not keen on pursuing it much, that is, build more hotels, given the heavy capex required and also the debt involved, which, as you know from the previous experience, it did not go very well for them. A leased hotel is one that has already been built by a third party. KHIL simply rents out the building and runs the hotel. So it keeps the revenue, pays all expenses, including the rent, and what remains is the profit. The lease model is the company's primary growth driver, as it not only gives the company full control over the customer experience, but it also allows them to take advantage of the upside during boom periods. As it stands, 13 out of the 24 properties that is there under the Kamat Hotels banner is under a lease model. Revenue share, as the name suggests, is where Kamath Hotels pays the owner of the property a percentage of the revenue instead of a fixed rent. There are 5 properties under a revenue sharing arrangement and forms a core part of the company's asset light strategy to enter tier 2 and tier 3 cities. The net return expectation from this model is 10 to 15% after the revenue share has been paid out. And finally, there are managed hotels or franchisee hotels, as some people like to call it. Companies like Indian Hotels, Lemon Tree, and ITC do this a lot, wherein while the company is owned by someone else, the operator, which in our case is KHIL, the operator manages the hotel for which it is paid a management fee, and that's typically around 7% of the revenue. So all put together, Kamat Hotels India Limited has 24 operational properties and 2,100 plus keys. And the company's near-term goal, that is FY26 goal, is to reach 26 hotels with 2,500 keys using a mix of leases and revenue sharing. All right, let's look at some important variables on which hotels are gently evaluated and where Kamath Hotels wants to be in the future. Actually, that reminds me, I had done a video um, I think a couple of years back, which was on the hotel sector. Let's see if you can find it. Yeah, this one here. The focus here was on learning the key variables, how to calculate, how to assess it. And I'd also given a glimpse of where different hotel chains, the top 4-5 hotel chains, where do they stand with respect to each of these metrics. So if you find the time, do watch it. I'm sure it'll be worth your time. Okay, so first up is ARR, average room rate. Prior to COVID, so FY19, the group's ARR was a tad above 4,500 rupees, which, if we ignore some of those COVID years, has generally increased. And this has happened in spite of the introduction of a mid premium brand like IRA. Please remember, ARR does not include food and beverages. This is purely the room rent. And I think all major listed Indian hotels follow this practice. It's very important for us to understand this though, and especially in the case of Kamath Hotels, 35% of the revenue comes from food and beverages, while the rest is room revenue. Another thing with the ARR number is that it has come down in the last couple of quarters. The management has put this on multiple reasons like monsoons, addition of new hotels in tier 2 and tier 3 markets, renovation in some properties, etc. In fact, Q2 was the worst, with data showing a sequential dip across all core brands, something all shareholders and potential investors in the company should watch out for. The other big metric is the occupancy rate, and on a consolidated group level basis, the occupancy has hovered between 52 and 65%, which I'm sure you'll agree is quite a big range. The story is similar here. Monsoons, new properties are yet to mature, natural calamities, and the management's own policy of prioritizing ARR over occupancy rate. But just to summarize so far, we have a brand that after much grief from 2010 until 2022 has finally started to grow in terms of revenue, properties, keys, ARR, etc. Since it has learned its lessons, KHIL is very careful with borrowings and capex, which is why it's more keen on asset-light models like leasing, revenue share, and maybe a few managed hotels. The brand is getting stronger, the equity is building, which will help the company as it expands. And they have done well to diversify their operations in terms of consumers with mid-premium and premium brands, in terms of revenue with a good 35% coming from F&B, and also in terms of geography having spread itself across states. All right, let's look at the financial side of things. And I think this is where the critical part of my investigation really starts. I think more than criticizing, it's more of frustration, and you'll see shades of that as we go along. Let's start with this part here. And over the last 3 years, the revenue as well as the operating profit has been pretty constant in spite of the number of properties and the number of keys increasing at a healthy pace. Let's look at it quarterly. And yeah, so in March of 2023, the revenue here is 81 crores, while the number of operational keys are some 1,510 keys. Actually, let me show it on a slide. So in March of 2023, 1,510 keys and 81 crores of revenue. March of next year, that is 2024, 85 crores in revenue, and the number of keys were 1,637. FY25 ended with 92 crores in revenue for that quarter and 1,824 keys. And the latest one in terms of declared results, September of 2025, just 75 crores in revenue in spite of having over 2,000 keys. This just doesn't add up in my head. And I'm not even saying that things have to be linear. Yes, there will be problems like the Shimla and the Manali properties. They've been non-operational for a good 3 months. But because I've gone through some 8, 9 quarters of earnings calls, it seems that there is always something bad that happens to Kamat Hotels, which doesn't allow them to have a great quarter. Except maybe this one, December of 2024, this is Q3 of FY25, where they crossed 100 crores of revenue for the first time, and even the OPM was excellent there of almost 40%. But this seems more like an aberration to me. And I have my reasons because, even if you look at the EBITDA here, see, again, it's pretty much the same thing, right? So 27, the number of keys have increased, but your operating profit has gone down to 23. Then it is at 25, which is not a big jump at all. And then in September of 2025, you get an operating profit of just 8 crores. But one thing I really want us to understand is the margins. Now, we had that exceptional quarter I referred to, 40%, but this is more of an exception, not the rule. So if you look at it in this period, it was around 39, 34, 33. So around the 35 mark, then it kind of tapered down, but was still stable at about 29, 28%. And what really bothers me are the most recent 3 quarters. So 27, 22, and 10%. So the trend is definitely downwards. And while the management wants us to believe that this is because of the seasonality factor or abhi hum expand kar rahe hain, so these things will definitely happen. But what I think really is happening is, or what I think is the major factor here, is the change in the portfolio mix, in the sense that higher the proportion of leased, revenue share, and managed hotels. Remember, we had looked at that earlier. The yield, the EBITDA margin, will start tapering down. Understandably, freehold or owned property offers the best margins, while managed hotels offer the least. So with Kamat Hotels focusing entirely on the leased and revenue share model, the margins will stabilize at a lower number, something that Mr. Kamath also acknowledged, which means a 35% EBITDA margin is out of the picture. He said it will come down slowly, but after seeing 27, 22, and 10%, I think it's best to keep our annual estimations at around 23, 24% when building a pro forma for this company. Okay, now that I've gone into the critical mode, okay, not critical, frustration mode, let's look at some more things related to this. Now, for some reason, the management at Kamat Hotels India Limited has a habit of getting their estimations and guidances wrong. And this shows up in the quarterly earnings calls when analysts tracking this company expressed their frustration and anger and disappointment. So this one's on revenue and profitability guidance. And Guneet Singh, an analyst from counter-cyclical PMS, was forced to say that is just a bit very lousy from the promoters to mention confidently that they will attain 140 crores of EBITDA and a top line of 400 crores. The CFO, Ms. Nanda's reply was equally stunning. Remember, we are sitting in Q2 of a particular financial year, and the management is being asked for guidance for that same financial year and not the next year. So to this, she says, it is premature to say in quarter one whether we will do 300 crores or 400 crores. She then points to certain capex and election period, both variables which are very much known to Kamat Hotels, but the team there is making it sound as if these are unknown and unexpected factors. Of course, the analyst will be frustrated. The same thing was pointed out by Shriyansh in the next quarter when he said, in your recent presentation, you have reduced the guidance from 400 to 350 crores. You also said the margins will be stable, but it has come down as well. In reply, Mr. Kamath attributed the lower guidance to two hotels which are not likely to open that year, that is, Orchid Dehradun and Orchid Chandigarh. He then goes on to mention that the opening will happen before the end of that financial year, so before March of 2025. This definitely got me curious, and I started tracking down what was said for Orchid Chandigarh and Dehradun over many quarters. Let's do Chandigarh first. And in February of 2023, the launch date was for April of next year, which is absolutely fine. 14-15 महीने तो लग ही जाते हैं ना यार होटल लॉन्च करने में. Then in November of 2023, same timeline, April of 2024, so just 5 months to go. Then in January of 2024, just 3 months to go, it's still April 24, and the management also says on track. Or ab April aaya, gaya, no announcement of opening, nothing. And then in the May investor presentation, we get to know that the timeline has been shifted to September of 2024. चलो हो जाता है क्या बोलते हैं उसे teething problem. And anyways, it's just a matter of 4 months. But then in the August presentation, pata chalta hai ki the timeline has been extended once again to November. And in the month of October, we get to know that the inauguration is in April of 2025. The pleasant thing is Orchid Chandigarh did finally open in May of 2025, and hopefully things are going well there. But I hope you can see the problem. If a hotel launch is going to get delayed by 12 months, then for investors or for researchers, for these analysts who are on these calls, it becomes next to impossible to make a projection. And even from a management perspective, we really don't know how much we should trust them on what they are saying. The even more frustrating part is that this is not the only time it has happened. In fact, it happens every time. Which was that other hotel in the October wala call? Yeah, this one, Dehradun, Orchid Dehradun. Okay, let's track this one as well. Actually, let's do both. That is Dehradun and Bhavnagar. So both were to start operations from April of 2024. The status is as of November 2023, so just 5 months to go. Then in January, we see that both have been pushed by 5 months to September of 2024. In May, it's still September, so lagta hai everything is on track. But by October, so what was already extended to September of 2024 in the last earnings call is now October of 2025 for Bhavnagar and December of 2025 for Dehradun. चलो फिर तो पूरे 1 साल की छुट्टी है. So let's come back after 1 year, and तब तक तो I'm sure दोनों hotels बन ही चुके होंगे.
1 year later.
Okay, welcome back. This is November of 2025, and I'm shocked to see another extension. The revised timeline is now April of 2026, and as it stands, both these properties have so far seen a delay of 2 years. Now, I don't know if this is a miscalculation on their part or if the management has this habit of over-promising and under-delivering. Maybe they are too casual, or they don't have the competence of kind of estimating things. I really don't know what the problem is, but the issue, at least from a me perspective, from a you perspective, is that it always, and from a management perspective as well, is that it almost always puts the guidance out for a toss. I mean, it never works out, whatever they say. And the sad part is, this is not just on the revenue guidance or on property guidance or things like that. It happens across the board. And let me share with you one more example, which is on interest cost guidance. So in the October 2023 earnings call, again, Guneet ji, he asked Ms. Nanda, the CFO, on interest expenses. The question was rather simple. What should we expect as interest payments for Q3 and Q4? To which the CFO replied that it would be 10 crores for the next half year. The analyst, Guneet, he reconfirmed on whether it would be 6 crores for each quarter, to which Ms. Nanda said correct. So you're talking about Q3 and Q4 of FY24, right? So this is December 23 and March 24. And as you can see here, the interest expense, it's 13 and 15 respectively, and not the 6 crores that the CFO, Ms. Nanda, had said. In fact, it takes another 2 quarters, so 11, 8, and it's only in quarter 3 of FY25, so December 2024, when we see signs of 6 crores of interest expense in a quarter, and that's where it has been since then. Now, again, imagine someone's frustration. Okay, so in here, you tell that the interest expense will be 6 crores a quarter, and it ends up at 13 and 15 respectively, and it takes a lot more months for it to go down to that number that was guided during this particular period. Somewhere the management should understand that they have a lot more information about their own business as compared to the analyst who's sitting on that call, or someone like me who's reading the transcript. And it is the management's job to kind of put things in an understandable manner so that even a third party can understand what they want to say across. And they should not try and confuse people or complicate matters, which I'm being a little subtle here, but in certain places, it seemed as if the management is trying to misguide us. It might be completely accidental, but that's the impression which I got. Even on the material that's provided on the, things like investor presentation, for example, I could see a rift between what was written in that material and what was said in the earnings call. Let me share an example with you here on this as well. So let's take this latest earnings call. And another analyst, Sanchit Agarwal, he pointed that while the company has given a target of 2,500 rooms for FY26, as per the company's presentation, there are just one more hotel expected to come up. The slide he was referring to in the investor's presentation is this one. And you can see here that if the Gwalior property does come up on time, that is March of this year, 2,100 plus 50 comes to only 2,150 rooms, which is much lower than the target of 2,500. To this, Mr. Kamath gave a very complicated answer, pointing to delays in the launch of properties like Bhavnagar, Dehradun, and Nasik. He also spoke of some never mentioned property in Porvorim, Goa, that suddenly came about and added to the target of 2,500. But the fact is, this Porvorim property is only 43 keys, which is definitely not enough to compensate for the balance 350. And finally, the management did what it always does. It kept the candle of hope burning and concluded with confidence of them reaching their target of 2,500 keys, which frankly, I am not very confident of. I'm very sorry if I'm being too harsh on the management of KHIL. I really don't know how else to say it or put it. I also don't think the management is trying to deceive investors. But then, carelessness is not an acceptable excuse. Uh, I really hope they do well. And if their plans do come to fruition in the next 2, 3, 4 quarters, then good for them. But there'll always be an overhang, at least in me, as to how much can I trust what the management is saying. In my opinion, this is playing on the valuations as well. And at least I'm finding it difficult to get a read on the company. So let's do this. Let's look at EV on EBITDA and see this on a EV-EBITDA basis. The EV multiple is currently just 8.5, which certainly makes Kamat Hotels one of the cheapest hotel stocks in the country. And this is in spite of having two really bad quarters, Q1 and Q2 of this financial year. But the real problem for me will always be in terms of, a lack of confidence in terms of populating numbers, because you still don't know, where this EBITDA is going to kind of stabilize, which makes it difficult for us to do anything. I'm also sure this is not anything that you will find in a screening software, which is why reading transcripts is extremely important. You get to know what the management's intention is, which definitely numbers won't be able to explain. And that's one of the core things I wanted to take you through when doing this particular exercise. This is not just a Kamat Hotels kind of a scenario I'm referring to. This applies to any small cap or micro cap evaluation that you do. Most of these are owner operated. The promoter generally has over 60% of the shareholding. And that's where understanding the management becomes all the more important. As far as Kamat Hotels is concerned, uh, just a word of advice, especially to the investor relation team there, that they have to get better with their communications to investors and for shareholders, not just for the investor and shareholder benefit, but for the benefit of the company as well. Okay, I might have jumped the gun, but to quickly summarize, on the outset, one might see a company that seems to be cheaply valued. The debt is definitely manageable. They've moved to an asset-light model via leased rev share and managed properties. The company has many properties now and is keen on growing it further. Orchid and IRA's brand equity is definitely going up, and there are tailwinds in the form of a growing economy, middle class, etc. However, what we can, or at least I can also see, is abrupt changes in revenue guidance, a rapid decline in EBITDA margins, execution risks with most properties getting delayed by 1 to 2 years, contradictions between what's said and what's written in the materials, and most importantly, the management's recent history of overcommitting and underperforming. I'm not really concluding anything from this, but this episode and this research definitely reminds me of a presentation, a video presentation by Mohnish Pabrai. Let me find this out. Okay, let's do Mohnish Pabrai Peking University. Okay, um, yes, this one here. Right. So the title is Great Businesses versus Great Investments. And what Mohnish is trying to do here is to build that distinction between what is a great business and what is a great investment. So he's taken a few examples. So an example of a great business for him, not for him, for his friend Guy Spear, but a great business is like MasterCard. A very kind of clean business, very well established, excellent return on capital employed, is a somewhat of a necessity in the present day world that you have to go through those Visa and MasterCard kind of channels. And on the other hand, Mohnish is presenting another company, which is an Indian company, which is Suntech Realty. And I think this video is 2019 when this presentation was done. So he's trying to kind of put a parallel between whether, all right, a MasterCard is definitely a better business as compared to Suntech Realty, but is it, uh, a great investment? So like this, Monish has also done a few more examples there. He also looked at Motherson Sumi, which we today know as Sambardhana Motherson. So he's looked at that company and has also looked at Rain Industries. So very good video. Do have a watch if you find some time. And I'm kind of drawing a parallel of this with my experience with Kamat Hotels. As I said before, it's on two different bases. One, as a consumer, excellent hospitality, very nice rooms, excellent food, very close to the mandir, when I visited there in Ayodhya. And yeah, I loved everything about that establishment. But do I love it as a potential investment opportunity? Maybe, maybe not, or maybe I'm not convinced at the moment, given all these complications that are there in the understanding of this business. So if you're a shareholder in Kamath Hotels or a potential investor there, then do consider these additional variables. That said, I do wish Kamath Hotels India Limited, the management and the team there, the very best for the future. I'm a consumer and I would love to be back in one of their properties in the near future. My only suggestion to them is to be a little more prepared when they have these interactions with investors or with shareholders. I think it's a very important part of their job, and I would really want them to do that well. I do hope you found this video useful. There are some additional variables that we have learned there. Uh, as always, thank you for your time. Do visit Ayodhya. Do stay at Era Ayodhya, and yeah, if you go there and you want some really nice guy to help you around, then do look out for Vishnu. You can probably get his number from the hotel's reception itself. So he kind of hangs around that place. Very good tour guide. He will take you around the place. He'll take you to Hanuman Gadi, the Ram Mandir, Saryu Ghat, Janak Mahal, and all those places. Sita Ki Rasoi. So all those things are there. And this guy is very helpful. Bit talkative, but really helpful guy. So yeah, so have a pleasant week ahead. And yeah, as usual, I'll be back in a few more days. And yeah, bye bye.